There we are.
Kids, Jesus, God, I'm old. There's dressing appallingly. It's like the 2000s all over again, basically, isn't it? I think.
90s, isn't it? Baggy jeans,
baggy jeans.
Are they flares? No, they're just baggy
White
jeans,
socks,
aren't
sliders, yeah.
There you go.
All in.
Yeah.
JR's got sliders under his desk at work.
White socks?
Not the white socks.
Don't like the silk tie, but yeah.
No.
Well, thank you for joining us, Jill. I'm very excited.
You're welcome.
It's nice to have some knowledge around the table.
Oh, you flatter me.
No, 100%. Looking forward to this. I mean,
This is our first professional guest.
This is our first guest, yes. We've been let loose for the first couple and now we've brought in some gravitas, so we have. Thank you for joining us again. This is episode number 3, Taking Stock After the Bell. I'm joined by, obviously, Gill Clifford, our first guest, financial planner with Quilter Financial Advisers.
Thank you.
Johnny Raymond, investment manager, and James Hughes, investment manager as well, and I'm David Henry. The last time we sat down and recorded, I said the markets were deathly boring.
I am so bored of this market. With your precise
There's going to be weeks, I think, where we're stuck with content. We're not stuck this week, so we need to get launched into it. We're talking about the 2000s. It all feels a bit 2007. What with banks going to the wall. Do you want to take us through what's been happening with the banks and what we think the similarities are with sort of mid 2000s, if there are any at all?
James?
I mean, we'll have to start with SVB, Silicon Valley Bank, which I'm sure everyone is now aware of. I'd be interested to know how many people had heard of SVB before a couple of weeks ago. It's a regional bank which was focused on private equity and venture capital. It took in a huge amount of deposits very quickly when money was being raised over the last few years for tech businesses. The problem was the loans they couldn't make the loans quick enough on the other side, as we've all now found out. So what they did was they didn't make risky loans. They bought very secure treasuries. Unfortunately, they appear to have forgotten about duration and fixed the trade or bought maturities of 10 years plus at 2% coupons. And as you've had an aggressive increase in rates in the US, it's that you've got very large paper losses in terms of those treasuries. And I think I can't remember the name of the group, but it's one venture capital advisor that sort of advised a few clients to start withdrawing funds, and there was a classic run on the bank.
I think what everyone often forgets about banks is that if all of us go to all of our banks on the same day and try and get our money out, we've got a big problem, because the banks can't actually give us all our money at the same time. It doesn't matter if you're JP Morgan or SVB or the Bank of Timbuktu. So the commonality with the issues that's seeing in the banks, and I'm sure we'll mention Credit Suisse in a minute, is that you've got interest rates have gone from 0 to 4-5% in the space of a year, and banks have not put deposit rates and savings rates up by anywhere near as much.
Yeah.
So if you're Mr. Snooks, or you're the finance director of a relatively large business with a load of cash on deposit with SVB or Credit Suisse or JP Morgan or Lloyds, doesn't matter, and you're getting paid 0.5% despite rates now at 4%, you've got the option of going to buy a short-dated treasury, US treasury, which is pretty secure, not price secure, but it's credit secure, or a money market fund, and harvest base rate, and base rate's 4-5%. So you're going to get a pickup in yield of 2 or 3% with very minimal extra risk, and I'm sure we'll talk about that later on. So, lots of these Silicon Valley companies who had cash balances and ordinary investors who've got significant cash sums, and we've seen a little bit of that in the business, moving their money out of deposit accounts and savings accounts that were paying them nothing into money market funds, which obviously is a strain on the banking system. And in the case of SVB, you've got those venture capital guys who are the founders and investors, just sort of nudging the finance directors of these companies and saying something going on here, and all of a sudden you get a classic run.
If there's any panic to spread, it spreads more easily between a group that are speaking to each other on a day-to-day basis, not just in person, but online.
Social media. So social media and technology is fascinating because there's two facets to it.
If you go to back to 2007, there were, the front page of every paper was everyone queuing outside Northern Rock.
Yeah.
You don't have to queue.
No,
press a button.
You do it on your phone.
Yeah, I bank with Starling. which is probably a bank to be slightly wary of, I guess. But it's the same, it's grown up with technology. But if I want to withdraw something, I press a button and immediately it's in my HSBC account. The movement of fund flows are so much more aggressive. And then when you've got the leverage on top of what's sitting in deposit and you're loaning it out, that's obviously where the difficulties come. I think, the big takeaway is, following the financial crisis in 2007, the regulator has a lot more, or they have the ability to act far quicker. And the amazing thing was they've backstopped deposit holders of SVB straight away. They're not individuals, these are businesses, and that just wouldn't have happened back in the day. No. So that's the real positive, and the regulators have done, in fairness, a brilliant job on this. But, I think there was a massive, there's a big buy case for banks at the beginning of the year with increasing margins.
We talked about it 4 weeks ago.
Yeah, we did. Yeah, but of course, there's a fine line between that spread or that margin being too big and people moving, and that's ultimately what's happened in this.
Banks are very delicate flowers that need very specific conditions to work, and if it's too hot or too cold, seemingly they don't.
No.
I mean, is that a fair assessment?
Yeah, James and I started our careers, early noughties, and banks are one of the best performing sectors for that 5-year period from 2002 to 2000 and the moment they all went bust. And they do need high and rising rates and reasonably good economic environment, and loose regulation also helps. And an asset bubble, I guess.
I mean, the other point to make is, the likes of SVB were less regulated than the major banks that we typically invest in. So, the JPMs, the Bank of Americas, those types of businesses in the US are much more highly regulated than the regional banks. Now, it was actually Mr. Trump that loosened the regulation. So they would have come under the same tight regulation that the larger banks would have done had he not reduced or increased the level. It was reduced to $250.
It was $50 billion.
Yeah, it was reduced
and
to
then it was increased to $250. Yeah, and SVB sat just underneath.
Yeah, so had it not been for that change in regulation, this probably wouldn't have happened. It may have still happened, but it's less likely to have happened. So it does go back to, again, the US being slightly looser in regulation than European banks and UK banks, and certainly the European regulator and UK regulator are much, much harsher on the banks than the US regulators are on their medium-sized banks. I guess you look at the size of SVB compared to the larger banks, and it's a pebble in the ocean. It's
16th biggest bank in the US.
I know
Which
that.
I was astonished by.
I was surprised by.
I mean, prior to 10 years ago, it definitely wouldn't have been those sorts of levels. No. I want to keep zipping through this because we've got a bunch to cover, but SVB, the initial issue was they bought a load of assets that if interest rates went up, they were in trouble, and interest rates went up, and that meant that there was a panic, and they had a tight group of depositors who are pretty close communication with each other, and that led to a bit of a stampede. So there's idiosyncrasies with that bank. The reason I bring that up about the assets that they bought, which were predominantly US Treasuries, I mean, it's hardly like the Big Short type stuff.
No.
Really risk-taking gambling. It's US government debt.
If you owned a 10-year US Treasury at the start of last year, you lost 20% of the value of it on the price move because interest rates went up. Because if you buy a US Treasury paying you 1% a year and rates are now 4%, the bond that you've got paying you 1% is not worth as much as it was, and that's called the duration.
And so the regulation that comes in now will probably be focused on duration management rather than risk-taking that we had before.
But that's what banks do, though. Banks, it's called maturity transformation. They borrow short from depositors and they lend long. Normally it's 30-year mortgages in the US or 5-year mortgages in the UK, but in SVB case it was 10-year treasuries, which is not wholly different to lending out on a mortgage, a 30-year mortgage. It's the same, you're taking effectively the same risk.
No. And of course when you're lending over 10 years at 2% and you're the deposit, you're not paying deposit at anything, that 2% margin on your money is absolutely fine. Of course, as we know, when rates go to 4 3/4 in the US, or they have a range of 4.5, 4 3/4, 2% is not fine.
No.
So and that's exactly what's happened. So I mean, it is quite amazing they have bought the safest assets they could.
On the
They
safest
just
asset on the planet.
they just
essentially.
didn't hedge the duration, which I would have thought. I mean,
You might-
the,
they might
the
have.
head of risk might not have a job again. But,
No. I mean, just you mentioned European regulators. Let's touch on Credit Suisse. SVB had idiosyncrasies. I mean, what's the score with Credit Suisse? Obviously, it's been rescued over the weekend. Chat of a shotgun type marriage with UBS forced by the Swiss regulator or by UBS, depending on who you listen to and who you think is the most powerful there. But Credit Suisse has, let's generously say, struggled, I think, as a bank for a couple of decades
Management issues. You know, they've been embroiled in pretty much every scandal going across the world. Anti-money laundering, all sorts.
also,
but not-
the CEO travelled through COVID on a private jet
Oh yeah, that's
when
right.
he wasn't allowed
yeah,
to travel.
the whole thing. It's just you know.
Yeah, it was one mistake after another.
But again, you got, not dissimilar to SVB, you had the people who bank with Credit Suisse are high net worth investors who've got deposits well in excess of the deposit insurance limits. So high net worth individuals with 7 figures. So, you know, the same, if they can park their money instead in short dated German Bunds or Swiss treasuries and get that yield pickup, they could do it because they had an investment account alongside their deposit account. So then you see deposit outflow. They had a lot of deposit outflow last year and it actually didn't cause too many problems. But obviously that's cascaded after SVB, and the Swiss government obviously decided they need to keep things inside their own borders.
I mean, probably
shotgun marriage.
Probably the final nail in the coffin was when the largest shareholder came out and said it wouldn't commit any more capital to them. It didn't need to say
The
that.
Saudis, wasn't
Yeah,
it?
they didn't need
They
to
just
say
had
that.
that.
I mean, that was just the end of the road, wasn't it?
It was.
As
a
you
lot.
say, there's probably a lot of similarities between Lloyds being forced to take over HBOS back in the day, and we all know how that ended up. Lloyds have never recovered, so I'm not. I'd be pretty nervous as a, to watching what would happen with UBS being forced to take on these assets. It'd be
Yeah, I think
interesting to see how this
UBS have
plays
extracted
out.
some assurances from the Swiss government, haven't they? There's sort of they're sharing the first X billion of losses, I think, with the Swiss government, if there are any. And I'm not saying that Credit Suisse's balance sheet looks like HBOS's did in 2007,
Very
which
true.
we probably don't know, because I guess most of the lending will be high net worth property investment and investment portfolio lending.
It's still got a
securities
reasonable wealth franchise, isn't
Yeah,
it?
oh, definitely.
Private banking
Yeah.
franchise.
Definitely.
Yeah.
Jill, when you're speaking to people about cash holdings, this hasn't been tested in the UK. I mean, thankfully, touch wood, none of the UK banks have been under any stress recently. But what the Americans have done would suggest that, the £85,000 financial services compensation scheme limit, we can probably assume that deposits above that would be backstopped if that were ever to happen. I mean, does that come into planning? I guess it's just prudent planning to spread your deposits around anyway.
Yeah, it is part of planning. We always encourage clients to make sure they have a good contingency, and that's partly just to make sure they've got that there for unforeseen expenses, but also perhaps when there is a bit of volatility, and if they have been drawing income from their plans as well, they've got that backstop too. But when it comes to larger sums of money, because we're thinking about the planning options and we haven't committed it at that point, then it is a conversation, and we do, and that they're much more aware of it now. They're much more open to that discussion about the depositors' compensation scheme. They know the limits, they know the joint amounts together. They look for familiarity in there as well. So the FCA is regulating that particular institution because there are providers coming in that are offering very attractive rates. So they will check those things now. So there's certainly been an education process since 2007 that I'm seeing when I'm talking with clients. And as you say, technology plays a huge part. They don't have to go down to the high street and walk in and open everything on an individual basis, which would have probably prevented them doing that back in 2007.
Yeah.
Whereas today, they're quite happy to do it. They'll build a little spreadsheet. They'll know exactly what their interest rate is and when it's going to mature.
You can't expect people to become forensic accountants when they're depositing money with a bank. And there's a difference between bailing out investors, shareholders in a business, and if that fails and your shareholding should go to zero. But the idea that depositors lose their shirt in that environment, I don't think is a palatable one. The governments, I mean, it's the £85,000 limit. You've got to plant your flag in the ground somewhere, but I suspect that if push came to shove, we would probably do what the Americans have done with SVB.
Mm.
We well, hopefully we won't have to see. This is credit default swap prices for a bunch of banks. Yeah, pick out Credit Suisse on this chart. This is sort of telling you that there's no contagion being implied by the market just yet. Is that fair, complacent? What do you think?
Well, there's no. I mean, as things stand, and things can change very quickly. Still, even with SVB and Credit Suisse, there isn't really an asset quality problem in the same way that RBS et al. Raymond had a ton of toxic assets on their balance sheet that weren't worth 100, they're actually worth 50. That's not the problem this time around. The problem is literally liquidity. Deposits have been leaving institutions. Now, there are plenty of regulations in place and backstops and Fed swap agreements and repo agreements, etc., that are there to enable banks to take advantage of liquidity so that they can, essentially stem deposit outflows if they continue. So I think these charts do tell a good story that there is no widespread contagion, and I think that so far things have weathered the storm. And the S&P 500 equity index is back above where it was for SVB went bust. So that tells you as much as you need to know.
Yeah. And I should say these are credit default swaps. Basically, the cost, the probability that the bank goes bust.
Yeah, the cost of insuring against it. Yeah.
I mean, there's been a lot of volatility, as you'd expect, in UK bank share prices and European bank share prices and US bank share prices. But actually, where we sit today, certainly the UK banks, a reasonable amount of those drawdowns have been recovered. And for the moment, it's it doesn't look like a wider spread issue.
James, do you think that the profitability of said large UK banks in particular has been compromised by what's happened? I mean, interest rate expectations have fallen, and they might need to put interest rates up on deposit accounts. Do we think that impacts profitability?
I think
because the bull case for banks is just that is that the banks can park their spare cash with the Bank of England and earn 4%, and they're only paying NatWest are only paying me 0.1 on my deposit account, and they hoover up the difference. So if we now expect interest rates to start coming down, and in fact they now have to pay me 1%, otherwise I'm moving my cash out. Yeah. What does that do to their profits?
I think I think we're probably all in agreement that we've seen peak net interest margins, and there was, that was a lot of the buy case for banks as we entered the year.
They're still quite cheap, though, aren't they?
I think that's the other side. They are very cheap, and there's very good dividends. And there's very good dividend yields. And I think actually, if you look back at the statements, the outlook statements, and to be honest, NatWest on the day of their results and Barclays on the day of their results, there was an outlook statement in terms of net interest margins, and they were probably slightly lower than the market expected. And I think they were actually very cautious in terms of where they were going. I think they probably knew that they had to increase rates they were paying to deposit holders. The question is, has the investment thesis changed for the banking sector? Is it as attractive as it was a few months ago? Probably it's slightly less attractive, but they are still very cheap investments, aren't they?
You've got this double whammy of stress, headline risk basically, stress the banking sector, everyone fights the last war, threw their hands up in the air and thinks this is 07 all over again. But also to your point, JR, you've got declining profitability and maybe because rates are coming down.
That's the biggie.
Which is the biggie, there we go. Expectations for the Fed funds rate, where people think rates are going to be, it's just collapsed as of the past couple of weeks.
And if
you're having to pay more in deposits, and then your profitability's worse.
I mean, sorry to interrupt. We said it either the last podcast or the ones before. You sort of made a slightly cheeky comment that you pushed off an actuals analyst and said it's never worked owning banks into a recession. And it's never worked.
I'm not taking the credit for that.
No, owning banks when
are we saying not into that?
when the yield curve inverts. That question is still there.
Yeah.
But but on the other side, they are exceptionally cheap, and there's very good dividend coverage, and excuse me, sorry. So there is a good investment case still, but. We've got to monitor it. That's our job.
Do you want to take that, by the way?
That was someone calling up about SVB.
What have you bought me a load of banks for? So, given what we're looking at the minute with rate expectations, Fed are obviously making their decision tonight.
Yeah.
Can
no point
you
preempting
name
this.
me a harder Fed decision than this? Well, I think the Bank of England have got a hard job
Bank of
on
England
Thursday.
tomorrow, probably. Yeah. The ECB
Tomorrow.
last week. I mean, the ECB have got form. So the European Central Bank put rates up 0.5% last week in the midst of Credit Suisse chaos, pretty much in the middle of it, just after SVB went bust. They were the last to raise rates in 2008, probably weeks before Lehman went bust. They also put rates up in 2011, just as the Greek debt crisis was kicking off. I mean, they've got real form, and they did 0.5% last week. So mind your eye on that. But this is incredible. You know, Powell sat in testimony to Congress 3 weeks ago, or was it probably, it might have been the day before the last pod, and rates were going to 5.5–6% in July, as the black line shows here on this chart. And then we've had SVB, and we've had a little bit of soft economic data. It's not, it's not been brilliant, but it's not been terrible. And now we're at the blue line, and the market's expecting a decent chunk of rate cuts by the end of the year. So the market's expecting 4%. I mean, this will be out of date by the time the
I
pod
know,
comes out.
yeah,
So,
but by the time this comes out on Friday, it'll almost certainly be
so
out of date,
they'll
but-
probably put rates up a bit, probably, because they won't want to. Because interestingly, I do remember they cut rates in March 2020 at the start of the pandemic. They cut rates by a full 1% in the first week of March, and even I was like, "Oh crikey, this is quite serious." And the equity market went to bloodbath that day.
Yeah.
I mean, I think if they don't do anything, the market might take the view the Fed knows something that we don't.
It's a tightrope.
If they do the 0.5%, which was priced in pre-SVB, I think everyone would say you're absolutely bonkers and behind the curve. So I know what I would do. I'd sit straight in the middle, but...
What would you, 25
Yeah,
basis
25.
points?
Because inflation, yes, it is coming down, but...
It's not coming down very fast.
It's not... No, so, we'll talk about it in a minute, but... CPI on services is a problem still, and as you say, I think Bank of England probably has the harder job.
There's three realistic options, I think. Do nothing, 25 or 50, and the case for doing nothing, I think, is on screen at the minute.
Yeah.
So you think they'll do nothing?
Look what you've already done.
I think they'll do 25, but that's
Yeah,
so
that's what I
boring.
think.
So I'm going to say they'll do nothing. Look how far we've gone in such a really quick space of time. Is that red line on the chart that you can see as the first line? This has been an extraordinarily fast hiking cycle. We haven't so much tapped the foot brake as jumped on it with 2 feet and pulled the handbrake for good measure.
Yep.
Why not sit and wait and see?
I totally agree with you.
Because there's another meeting in 5 weeks. So it's not as if we've got to sit through the summer and you've got a load of data points between now and then. The counterpoint is of course what you're saying around inflation and services inflation. Is quite
Services
sticky.
inflation is not coming off quickly from what we've seen, but it is a lagging indicator. We know that. It's,
lots of economists would say that rate hikes work with a 12 to 18 month lag. So we're just about hitting the impact now of the first rate hike.
so pause and be patient is probably...
Now, maybe it's not 12 to 18 months. I don't know. I haven't run the data.
But there are
I'm going
arguments to
either.
say actually it all happens a bit quicker now, but everyone's got a different viewpoint, haven't they? But historically, it's
We shall
say,
find
12
out.
to 18 months.
We shall find out.
We will find out, and as we covered last time out, actually you don't necessarily need a roaringly hot economy for the stock market to do well. Sometimes it can.
No, the other thing to come back to the point about expectations management, 0, 25 or 50, how does the market react? I mean, it's just finger in the air stuff, isn't it?
Well, you could make an argument for either way.
Yeah.
You could make a positive and a negative argument for nothing, 25 and 50.
I think
it just depends.
My bigger picture opinion on this is that if you are trying to second guess how the market reacts to a fairly unpredictable Fed rate decision for the wealth preservation and enhancement in your account, then you need your head tested.
You need to grow up.
That's
you need a growing up investment.
Not the way to get rich.
Because it's going to consume your life if you behave like that, and B, you're not going to get a good outcome.
Well, it's control of controllables again, isn't it?
Yeah.
It's doing the work on individual businesses and making sure we're invested, across the piece on
And-
very good quality names.
And in that control the controllables bucket, obviously, tax is a big element. It's not just been banks; it's been the budget as well that we had since
Feels
last
like a
time
lifetime
out.
ago now, doesn't it?
Does seem a little bit of a while ago. Assume, Jill, for a moment that I'm a moron. I know that's a big assumption. Assume I know absolutely nothing. Explain to me the lifetime allowance as it was and the changes that we've had as of last week, wasn't it?
Yeah, so this all came about following the spring budget, and the rationale behind the message that came out from the government was that this is a budget for economic growth, and it was to get the over 50s back to work. They all seem to have left the workplace
We talked
following.
about that, haven't we?
Yeah.
It's a big issue.
Yeah, following COVID, decided to take lifestyle changes and so on. And the Chancellor has said this move would encourage the NHS doctors, consultants and other high earners back into the workplace for longer. And this is all around what they've done in respect of pensions and the lifetime allowance, as you've mentioned. And so currently that lifetime allowance sits just over £1 million at £1,073,100, and from the 6th of April this year it's going to be completely abolished, which means anybody that's very close to that limit or in excess of that limit is not going to be penalised by being in excess of that limit any longer. So it becomes much more attractive for those high earners or those who have been investing into a pension for many, many years to continue to invest into it and therefore continue in the workplace so that contributions can be made.
Mm-hmm.
So you've had basically a bit of a result for pension savers, is that fair to say, and high earners as well, because you have that, not only the abolishing of the lifetime allowance, we'll get back to whether that lasts in a second, but also you've had an increase in the amount that you can put into your pension as well.
So currently the annual allowance is £40,000 per annum, and that's going to increase again from the 6th of April to £60,000, so a 50% hike.
Which is material.
Yeah, it's huge. It's absolutely huge. And again, the rumours we had before all of this came out was the lifetime allowance expectations were in the region of around 1.8 million. But simply just to abolish it was kind of something that took us all by surprise.
Did you watch him announce it?
Did I?
Watch him announce it?
I was listening to it on the radio, and yeah, it was quite a big dramatic piece when he did say it.
So smug.
Was it?
Yeah, it was. Yeah, it was a huge.
It obviously had some coaching and how to announce it before. It was absolutely appalling. But I mean, listen. The question is, obviously it's good news for pension savers, not least because the lifetime allowance rules, I think it's fair to say, are quite technical. Good for planners and advisors.
Yeah, absolutely. And again, it's great from a technical point of view because there are still some nuances around it.
Yeah, sure.
You know, there's people who've got fixed protection and individual protection over many, many years because this has been going on for years and years and years, where gradually the lifetime allowance has been reduced to such an extent and people have already exceeded those specific allowances, were allowed to put protection in place to protect that current level of pension at the time, which means there's question marks around what's the implications for them. Now, government have come out and said, because one of those little nuances is the 25% tax-free cash you're able to take is fixed at the current lifetime allowance.
It's quite sneaky, that.
It is, but again, it's
because interestingly, by abolishing the lifetime allowance, yes, the government don't get the tax revenue on the lifetime allowance charge, which was what, 25%.
So if you were in drawdown and taking
was-
an income, anything in excess of the
Yeah.
lifetime allowance was taxed at 25% on the excess element, and if you took a lump sum, it would have been 55%.
But what it means is that if you're effectively limiting the tax-free cash, there's more of the pot that's going to have to be drawn down as income tax, with income tax payable.
Yeah, but you can manage
But
that.
you can manage that.
Yeah.
Of course.
So
If you go back a bit, when were the rules changed? Because historically you had to annuitise all of your pension fund at a certain point in time, wasn't it? At 75?
Yeah, so
cap drawdown or
So there's a lot. So you had in 2016 we got freedom of pensions.
2016.
Yeah,
right.
came into
It's
effect.
not that long ago, is it?
No, it wasn't. And that allowed you to do far more with your pension at that point. Absolutely.
So broad headline is good news for pension savers, and if the lifetime allowance has been sort of a reason that you discounted a pension, maybe look at it again, I guess, with fresh eyes.
Absolutely.
General sort of follow-up question. This is really tough because the obvious pushback that I think you said a moment ago that you've had from clients before we were recording is, well, the rules are going to change back anyway. I'm not going to ask you to speculate whether or not that happens, because probably in order to do that you need to know the result of the next general election. How do you think about that? If you think that tax is going to change down the line advising clients, do you say to them play the landscape as it is at the moment, or do you try and think about what may be coming down the road? Because that's tough, right?
Yeah, so there's a number of factors there. One, it's the individual's personal circumstances, and that's crucial. Two, it's the current levels of their pensions. What are they at the moment? We can only plan on what legislation tells us today. We don't have that crystal ball. We can't predict what's going to happen going forwards. However, there is a shortage of resources in places like the NHS. This was one of the reasons why he's done this. It is a complicated area, certainly with the NHS and certainly with their pensions. He could reflect on it. He might bring in a limit, he may not. Now, we can't speculate on that. No. We don't know. We just simply, we don't know what the outcome of the general election or when that will be. We can only plan for the benefits today. And there's huge amounts of benefits by pension planning.
Pensions were attractive anyway.
Absolutely.
This is just added to it.
Yeah, and it should be the first. It should be the first thing you're considering in terms of, if you've got a mortgage, you've got protection in place, it should be really looking to plan for your retirement. And I think in your last podcast, Jonathan, you mentioned about state pension going up by 10.7%.
Did I? Yes, I did.
And for those that, and for those that have got the full allowance, it's 10,600. That's not going to look after most people in their retirement. So it's an incredibly important piece of planning, because of there's nothing as tax efficient. ISAs are the next closest, but there's nothing as tax efficient as your pension, and therefore it's really, really important to be looking at pension.
So lifetime allowance limit's been removed. If clients start adding to pensions again and there's good growth, and there's a different government that comes into power in the next general election and they reverse it, is there a danger that some clients that were close that have added might end up with a tax charge?
So what's happened previously, where you've got a lifetime allowance, or at the moment, from April there won't be one. Yeah. So if there is an introduction of a lifetime allowance limit, and we don't know what that might look like, previously there's been an element, a period of time, if you've been close or near to that current limit, or close to the limit that they're going to introduce, you've had the ability to be able to fix or protect that current limit.
Sure.
So
that
but
would
again,
likely happen.
Yeah, it's a speculation. You don't know if it's allowed to happen, but I would expect something like that to happen.
There seems to be a bit of a tightrope again being walked here, in that if you were to do that and you weren't allowed people to sort of lock in at a higher level, and you keep chopping and changing and making the rules for pensions less attractive, you've got the state pension, which is a massive cost to the government, and you'll need to incentivise people to save privately and take that risk onto their own balance sheet. But if you keep chopping and changing the rules on pensions,
totally,
I guess it makes it less attractive. So even the environment can't become massively less favourable, I wouldn't have thought.
No. The problem is you've got people look at pensions, they're a long-term savings plan, and so the younger generation don't like the look of them because they're thinking about the mortgage, they're thinking about saving for that deposit, and then they can't think that far in advance. However, there's a clear message come out from governments that the state pension was reformed around 2016 as well, and that is going to be looking after us less and less. So it is really, really important that you do start planning as soon as you possibly can, and it's never too late.
Well,
to
auto
plan
enrolment's helped in that, hasn't it?
Hugely.
So everybody
Yeah.
starting out now at 22. I mean, one of the downsides, of course, of auto enrolment is that the typical career path is you work at 5 or 6 different places in your first 20 years of your career. So you end up going to have 5 or 6 different pension pots with a few quid in each of them, and that's and we've talked the government dashboard, etc. might be coming to help that, but definitely the move is away from. At some point in my lifetime, there's probably going to be a means test on the state pension, I would think, because again they need to cap that cost.
Possibly.
It's total speculation, by the way.
Yeah, it
but,
is. Yeah.
Auto enrolment has been set up with a long-term kind of view in mind of reducing people's dependence on the state in old age.
Yeah. And pensions, whilst you talk about changes in legislation, they are much simpler these days. You may not think so, and I know you've got that look on your face, David, but they are much simpler, they are much more straightforward. You've got nuances from really historic old versions of pensions, and we come across them from time to time in planning, but in general, with auto enrolment, the process for investing and staying invested has become much simpler for pensions, and there's nothing as tax efficient out there. So we should be encouraging all of our clients, if they're not already, to be revisiting those pensions, because it is the tax breaks are there. It's been great for now in terms of that planning piece, and it's really important to do that, and do it alongside other pieces of planning.
Absolutely brilliant. Thank you very much. On the theme of controlling the controllables, Johnny, thank you. You put this together. This was on the back of a really interesting, I thought, piece in the FT about the gilt market. Interesting and gilts don't necessarily sit all that well together in the same sentence.
No.
But there's a little bit of a quirk in the gilt market at the moment, which could lead to some interesting opportunities for higher additional rate taxpayers. Johnny, so you put this together. Do you want to talk us through it?
Yeah. The first thing to say is we are not tax advisors, and we do not give tax advice. Second thing to say is the quirk in the gilt market is if you buy a UK government bond, and in the similar way as to the UK equity market, there are a number of different gilts that you could go and buy in the market tomorrow. And as the table here shows, I put 2 gilts up, and they're both very low coupon. So when you buy a gilt, you pay a price for it, and the price is per 100. So 94, 96, 98 pence per 100, and you get a coupon based on the par value each year. So we've got 2 different gilts in issue, a 0.25% 2025, so you get your money back in 2025 at 100, versus a 5% March 2025. So they've got the same duration, i.e.
when you get your money back.
When you get your money back, pretty much on the same date. But obviously the price you pay for each of those gilts is very different, because the 5% coupon, you're getting more income on the way through, so therefore you're prepared to pay a higher price for that because you're getting more income. The low coupon gilt's got a lower price because you're not getting as much income, but you're going to get 100 back instead of 94. So the quirk here is that 0.25% 2025 gilt, the move from 94 to 100, if you buy it today and hold it to maturity, that 6 pence uplift, which is a 7% growth, is tax free because there's no CGT, no capital gains on a gilt. Conversely, with the 5% coupon 2025 gilt, you're going to take the coupons each year. So the income return there in the third row down, that's the cumulative income that you're going to receive over 2 years if you put £100,000, £9,700, which if you're a 40% rate taxpayer, you're going to give away a good £4,000 in tax on that. So your after-tax return is a lot lower, 1.6% if you simply annualise it on the high coupon gilt versus 3.4% on the low coupon gilt.
So by selecting the wrong, in inverted commas, gilt for a very similar duration, you have halved your net return.
Absolutely right. So when I started out in the good old days of 5-6% gilt yields, my old boss we would never buy above par gilt. You always bought below par gilts, just because you're giving capital away and you're paying income tax. So it's always been a thing. We only ever buy gilts if we can help it out. The last few years has been very difficult to buy gilts under par because most of them have been priced quite highly. But the comparison is there to a savings account at 3% interest rate, where again you're only getting income return. There's no capital growth involved. So again, you're giving away 40%.
Not the same asset.
Not the same
cash
asset.
versus
Cash versus gilt. Different
again,
credit risk. I mean, you could argue the government's lower credit risk because your government's not
You
going
could
to
at the minute.
But you do have price volatility with the gilts, clearly, between now and redemption. But as that gilt gets closer to redemption, you get this what's called pull to par, because you know you're going to get 100 on the 31st of January 2025, then the volatility of the price falls between now and redemption. And you can do this exercise across different durations, so you can buy a 10-year gilt with a super low coupon, if that's what you're into. And I just thought it was interesting that, effectively, the FT article written by, was it Toby Nangle? I think it was Toby Nangle. Talked about the US municipal bond market, which is effectively their state-issued bonds. The New York State issues municipal bonds. The coupons on those are tax-free, so the effective yields are a lot higher than traditional treasuries. So that's where the comparison came from. And you've now got the same in the gilt market, where you've got these low-coupon gilts, where potentially, for higher rate taxpayers, so we're not tax advisors, there is something interesting there, in my opinion.
If you were tuning in hoping for exciting stock tips, we've just given you the January 2025 gilt. Slightly more exciting. Did you see Scottish Mortgage today?
I didn't. I had a trustee meeting this morning, so I missed it. But
I missed it as well, unfortunately, David. So you're going to have to fill us
go on,
in.
you can fill us in.
Yeah, I did. It was really good. We had them into the office here this morning. Kind of the poster child, I would have thought. Is it fair to say, for high growth tech type style of investment, hyper growth probably. I thought this was
Amazon before anyone knew about it.
Yeah.
Tesla.
What we've seen in recent months, and you pointed this out to me originally, Hughesy, is kind of a little bit of a disconnect in the price of Scottish Mortgage, which is the green line here on screen, and the Nasdaq, and this is sort of tracked quite tightly over the last 12 months. Reason for that?
So, I think there's a couple of. I mean, the main one is the private holdings. Essentially, as the listed investments within the trust have devalued over the last year, 18 months. Obviously, the mark to market happens every second of every day. They are live values, whereas the private investments within the trust are slower to be marked. Essentially, the private part of the segment, although they're not necessarily adding to that part, it's become a larger component of the trust. Now, to be fair to Scottish Mortgage, they are probably more active at marking their private businesses than a lot of other fund managers. But there is a disconnect between their private businesses have certainly not fallen in value as much as their listed businesses. Now, they are in similar arenas. There's something going on that you could argue that they should both be marked down at similar levels, but essentially the private side has become a much bigger component. They also had some Chinese private businesses as well, which, when China was a real concern for the market last year, shareholders fled, and that's why you've got the discount kicking out to where it is.
Yeah, that's what we can see here. Red line is
the
NAV, and the blue is the price of discount.
And more latterly, you've had the board issues, which is probably only the last
headline
week
news today, isn't it? Yeah,
it's headline news today that the chair has stepped away, and one of the non-execs has sort of come out saying he was going to open all about some of the internal issues and fighting. So I mean, it's phenomenal. It's gone from the end of 2021 probably being in, it was the poster child of every tech portfolio, and Tom and James just had done a phenomenal job. I think at one stage they were the second largest shareholder in Tesla behind Elon Musk. They used to get direct access to Jeff Bezos. The way he used to look at shareholdings in Amazon was he'd look at the percentage holding you had and times it by the number of years you've been a shareholder. And they were, I think, one of 10 shareholders that can make a call with him. That's, they were, I think the biggest attractor over the years was they've got a 10% limit on holding size. Biggest attractor for the fund was they were forced to sell Amazon to keep it below the 10%. So it's been a phenomenal success story, but when rates go from 0.25% to 4%, in the UK, the attractiveness of those future cash flows are not what they were historically.
We haven't got a longer price chart, but it's not as dissimilar chart to what we were looking at a few weeks ago, the pandemic A's, wasn't it? The 5-year numbers on Scottish Mortgage look brilliant. The 18-month numbers look pretty dreadful, but they had a startling rise in 2020, 2021, which have just come back down to earth. But over 5 years as a shareholder, you've still done pretty well.
Yeah, I wonder.
Really well.
I wonder over 5 years they're probably certainly top decile still, if not. I guess there's probably 150, 200 fund managers that play in that arena. I'd be amazed if they were outside the top 10 still over 5 years.
Amazing, isn't it? Even after that round trip, I should say I hold it in my personal account, so I'm hoping they turn things around.
But I mean, you look at this discount. It's gone from you at the beginning of this chart, the price was trading at net asset value. I don't know what a discount. There is looking
that gap between
250.
Blue line and red line is badwill, effectively.
Yeah. I mean, it's it's an amazing
if it goes
discount.
The other way, it's goodwill. But just shows you these styles of investment go in and out of favour, and when it turns quite aggressively, and that's why I think being a value investor has historically worked, because as a factor it's so hard to stick with for long periods of time. Scottish Mortgage is unapologetically a growth investor, and if growth comes back into fashion, I'm sure it'll do incredibly well again. We shall see. Of course,
the last thing to mention on the private investments is they have a cap, don't they, on the amount of exposure they can have to private. And when these private investments require another round of fundraising, they are limited as to how much they can put into these businesses, because they can't
go
blow
above the ceiling.
And then that comes to a shareholder vote, and at this point in time, the shareholders of SMT want more private exposure. So, it's this sort of goes back to, Dave asked you last week about, you're a member of the funds committee. What do you like to see? And it's people changing styles. With Tom Slater and James Anderson's no longer part of the fund management side at Bailey Gifford, but the style is consistent. They are growth investors. They are looking for the Amazons of tomorrow, and this is a great way that you can get invested to businesses that you can't do on your own. But it should.
Dovetailed with something else that doesn't look like this.
You probably wanted to look slightly different.
And it's a small percentage of a portfolio is the way to do it.
Size it appropriately, don't get mad whenever their style of investing is out of favour, and
take profits when it goes up.
Yeah,
don't be brave about topping up when it goes down.
100%.
Well, this is it. This is
Very
a classic be greedy when others are fearful. Is this the time? Dave is a timing genius. It's in his PA portfolio.
Genius. Well, I don't. Well, we'll see. It doesn't feel to me like. It doesn't feel to me like we've seen real bear market panic at any point over the last couple of weeks. But listen, we'll see. I'm generally quite an optimist, so hopefully we'll always muddle through. Of course we will. Cool. That's brilliant. Let's get out of here. That's more than enough for this week. Thank you for joining us, Gill.
Thank you.
Thank you so much.
Can I just say, when you asked me about the reform to annuities and so on, it was April 2015
was it?
And not 16.
April
So my
2015.
apologies for that.
Amazing.
The
We
record is
are all
corrected.
about accuracy.
So I'm sorry.
We're not going to apologise for any of the mistakes that we've made over the past couple of weeks. Jill, thank you so much. Hopefully we'll get you on again soon.
Been a pleasure.
Gentlemen,
really good.
thank you very much. See you next time in a couple of
Finish
weeks.
the CGT, all done?
Yeah, I'm
ISAs,
done.
any
ISAs
investment
done.
ISAs?
I am
Good.
done.
Yeah.
You?
It's
Pretty
an ongoing project.
Pension contributions?
It's an
Pension
ongoing
contributions.
Pension
project.
contributions.
Get my abacus out.
If you need to do something before the end of the year, please
Go and see
do
someone
it.
else.
Very soon.
Give us some
Yeah.
notice. Guys, thank you so much. That was fun. Thanks for joining us, folks, and we'll see you next time.
Thank you very much.
Thank you.
Thank you.